Investor Expectations. Prepared for and presented at the 2016 Square One Entrepreneurship Training Program. Square One is a program of the Center for Emerging Technologies. CET is an affiliate of the Cortex Innovation Community. Square One is funded in part by the Missouri Technology Corporation.
Can you start us off, Scott? We often hear that it's the idea, the plan, and the team. Investors have to believe the idea is worthy, believe the plan can be executed, and believe the team that's been assembled can execute it. Is any one of those particularly more important to an investor? And is there something that we're missing when we're only focused on those three?
The idea, the plan, the team?
Yep.
Well, how about the investment itself? But I would say the most important thing is the team. And a lot of young companies don't have the benefit or the luck of being a been there, done that entrepreneur. But I can tell you that being a been there, done that entrepreneur, or associating with them, whether it's through a strong advisory board or a real board or sort of co-founders, is, from our fund's standpoint, in my experience, in looking at companies that are successfully raising capital, that's number one. Number two is, there's almost no number two.
Okay.
That's not to say that if you don't have that experience, you're not going to raise capital. But when you look at the universe of where money comes from, people who are most likely to invest in you are people that know you, love you, trust you, right? Friends and family. They're first. But when you need to go outside of that community of people that already know you, then you need to sort of have a leverageable management team. And from a professional money standpoint, that's critical.
And you said the investments. What did you mean by that? Is that the term sheet that's actually put in front of you, or
a stage appropriate, terms of your investment? Someone mentioned earlier, you can't, if you're not a been there, done that entrepreneur who's had 6 exits and this is the best idea you've ever had, you're not getting that $10 million valuation pre-revenue, right? So, are you putting an investment in front of someone that makes sense for where you are and who you are at that time?
Great. Christine and Craig, could you also comment on that as well?
I totally agree with Scott. I think that team is most important. There was a time in my life where I didn't believe so. And after being on boards and after being able to sit and watch companies progress, I think team is especially important. It's important that you have the right kind of people too. So not only a team that has done a lot of things in their past or a team that has, some cohesiveness, but it's also important to have all of those right kinds of needs filled. So you need to look at sort of where are the major risks with what this company has in terms of milestones that they need to reach. And do they have the team members who have that kind of expertise, that functional area expertise, or know how to get that? So that's what I would totally agree.
I'd agree with most panelists as well. I think that the team is extremely important, but I also think that for me as an individual investor, I think that the leader is probably the most important to me, because I think you can make changes to the team, but you as a leader, are you able to adapt to changes? What do you have the temperament to make good decisions when the difficult conversations come up? And so I think that that's most important for me.
Great. Craig, staying with you for a moment, you mentor in addition to investing and having led your own venture. When you're mentoring an entrepreneur, what advice are you giving them about raising capital from any source?
I'm surprised at the number of businesses or entrepreneurs that don't have business plans. As a mentor, I would say that less than 10% of the people that have come in to us to be mentored have actually had business plans, and I think it's extremely important to not only for yourself to have a benchmark as to how your business is doing or the direction that you want to go, and be able to, if you do have to change courses, you at least know where you started and what those changes have been. But to investors, even, they want to see a business plan. They want to know that you understand your business and have a direction or at least a path that you plan to go. Again, even if you have to make changes, at least you show them that you're organized enough to have given thought to your business.
Christine and Scott, would you agree that the business plan is not yet dead? Because I know some people would love for it to be.
I totally agree it's not dead. I agree, though, that there are several different ways in which you can do a business plan. I've seen really good business plans done on Word, but I've also seen some really good ones done on PowerPoint. And so I think you need to tailor that to who you expect your audience to be. I think also that entrepreneurs just need to be aware of what kind of funding mechanisms there are available within your ecosystem. I've spent some years putting together a money map of St. Louis. If you want to give me your card at the end, I'll be glad to get that to you. But just looking at the different kinds of clusters that we have and what kind of funding is available for each cluster. So I'd be glad to get that to you. But just be aware of, what kind of funding. Also be aware of, too, I think because Shark Tank is so popular these days, a lot of people think it's going to be like Shark Tank. You go in there, you give, a 2-minute speech, and that's it, and they make the decision right there. It's not like that at all. Also be aware that you pretty much are not going to set your valuation. It'll probably be set for you, and let those venture capitalists, the angel investors, whoever it is that you're in front of, let them set the pre-money, because that's their job. And so don't try to do that for them. That'll show that you're not as savvy.
Yeah, I think there's so much information to be read about the business plans and presenting material, and a lot of times that information is coming out of Silicon Valley or places where it's just a completely different marketplace. If you're raising money in the Midwest, whether it's a traditional business plan or something that's more investor focused, you have to be able to answer. We sort of track 15 or 16 questions that we think everyone needs to answer, most of which would be answered through a business planning process. But whether you need an operational business plan that you can launch a rocket with and talks about what kind of pens you're going to buy, like in a traditional sense, I don't think so. But something that would demonstrate to someone who cared enough to sort of want to know that you've done it, that you've answered these critical questions about the business, about the management team, about the offering, so that they understand from where you are stage-wise. If you're pre-revenue or anything, do you have a plan to get to the next milestone or a series of milestones?
Hey, we haven't really talked yet in this group about the importance of syndication. But as was just said, raising money here in the Midwest is a little bit different.
Harry, can you define syndication?
I'm going to.
Thank
in just
you.
a minute. So here in the Midwest, even just to raise seed stage capital, typically more than one investor is involved in a syndicate. Okay, so speaking from the buy the generator point of view, we frequently invest with Helix, and the MTC typically gets involved, and so there are a lot of different. iSelect is also one. I've personally seen a deal just within the last week where they said we are already in discussions with iSelect, Helix, the MTC, and a East Coast venture fund, and buy a generator. We'd like you to come in and fill out the syndicate. In fact, we'd like you to lead it. Okay, so a couple concepts in there. There's an investor that takes on the responsibility of performing the diligence for the other investors, typically in the syndicate. Certainly the other investors can ask questions, but the lead investor does the heavy lifting on the diligence. Okay, so that's what a syndicate is. A lot of different investors coming together to support a round. So here's the question that did you want to comment?
Yeah, let me just comment in terms of the importance of that. Different groups, and the importance of syndication is this. Different groups will have different kinds of expertise. And so when you get your boards together, coming from these different investor groups, you're going to be able to get a much better board than if you just had a single investor. So view it as a really positive thing to be able to pull together this syndicate, even though it's going to be a little bit more work for you, because you're going to need to connect with a bunch of different investors. It's going to be much more beneficial in the long run because you will have people who have different kinds of ways that they can help you.
So now, thank you, Christina. Now to get to my question. So we have these syndicates, and frequently people come to us, as I just mentioned, and they say, we're already in discussions with these other funds, right? So then we make a phone call, and we call up Christine, and we say, hey, are you talking to such and such? She goes, never heard of them, right? What's happened there, right? Well, she may have talked to someone that's involved with the Helix Fund, or in the case of the biogenerator or the company on the East Coast, maybe they've talked to an entrepreneur in residence or an analyst that's associated with the fund. So my question to the panel is, when we call you and say, are you really in discussions with this company, at what point do they have to be with you in order for you to answer that question yes?
We looked at 700 companies in the last 18 months and invested in 16. So I would say, before you shrug your, I want to get to a point here that we talk to communities like this. This conversation about professional sources of money is way ahead of where you are.
Yeah.
You're not candidates of professional sources of money. And so while this is important to understand where you're heading, this isn't the first $50, $150, $200,000 kind of money. This is, that we'll talk, hopefully we can talk about where that money comes from, but we're talking about that next stage. Once you've been validated, once you're in the marketplace, once you've hit some critical milestones, then some professionals, and even that community is pretty small when you've only raised $250,000 and you're only looking for $500,000 or less. That's a small community of professional funding sources. So we're at that iSelect level or the biogenerator level, you've made it past the accelerators and the post-accelerator money, and you're now looking to be part of a bigger game where that's when this idea of syndication comes up. And for our fund, we don't invest unless someone else is leading the investment, which means someone else is defining the terms, not us, another professional source of money or someone who really understands your industry. We're not at a place where yet in our development where we're taking a lead in a company. So to answer your question from my point of view, is it a long and arduous process to get through our diligence process? So we may say that they're in some form of diligence. We have a selection committee for different verticals that we look at. We might say that they're discussing it with our selection committee, but then it has to go through multiple levels of additional diligence. So be careful, I would say, because you could really undermine your credibility if you're trying to sort of leverage things that don't exist.
Before we get too far away from the idea, plan, team question, I wanted to ask Craig the rest of the panel's question. Craig specifically, it's Craig, right?
Yes.
Okay. Because you specifically talked about the importance of being a founder or co-founder and whatnot. And I guess this goes for the three of you. What has been your experience with non-technical founders? What do you specifically look for? Because they have a higher propensity to fail, right? And then secondly, what has worked well for them in your experience? So focusing on non-technical founders.
What has failed?
Well, okay, so ostensibly on paper, non-technical founders have a higher likelihood of failure.
Sure.
And I suspect that you and your histories have invested nonetheless in non-technical founder.
Is that a data-driven statement or your sense of?
That's the prevailing knowledge. That's what Kristen told me, so that's my data.
Well, it's from the non-technical founders have a harder time doing all of this. So one conclusion could be that they fail at a higher rate.
Okay, well, let's
But
take that as
we just know that you have an additional hurdle.
okay, so assuming that then for the purposes of the discussion. Okay, fine. And so you don't scrutinize more heavily against non-technical founders. I guess that's kind of good.
So by
Talk to us about your feelings about non-technical founders.
Actually, yes. And if you've seen things work well for them, what did? Because
So just for clarification, a technical founder is someone that has experience or background in the product or service that they're. Sure. For me personally, as an individual investor, I would prefer that it's a technical founder, someone that really understands the nuts and bolts and the ins and outs of the company or the industry. Every investment I've made, it included a technical founder at that company, so that would be my preference. Is that your question?
I mean, that's good to know. I mean, have you invested in a non-technical founder? And if so, like, what worked well, if at all, in those circumstances?
We do. We have. But part of what we'd look for would be that whole team, right? So it may be that that particular CEO is a non-technical founder. That's fine. But who are they surrounding themselves with? You know, who else is part of that team that can add that technical expertise that's really needed? And it doesn't necessarily have to all come from the team themselves. It could be advisory board members, other people that are not necessarily part of the day-to-day operations too. So it could be that.
Yeah, I'm not sure I have much to add other than we look at the team, not necessarily a founder. I would say there needs to be a technical person on the team. A non-technical person can't really validate the technology the same way as a technical one could. But you know, in my experience, the technical founder is probably more wed to the technology than he is to the business. And so a non-technical founder who has experience in making those pivots or hip checking the company down a different path. I mean, if you look at the companies that are later stage, and many of the companies that are later stage, the non-life science companies, the more technology companies, and you look at their original business plan, someone made good decisions along the way. And in my experience, my observation, it's usually people that join the company later that have more kind of been there, done that CEO kind of experience that say, you're kind of, let's just pivot this way and try that. And I think that's what a lot of investors look for is that decision going to be made at the right time, and who's going to inform that?
Let me just add one more thing. I've also seen too where you have a technical founder, maybe someone who's a scientist who's brought the technology out of a lab, or a tech person who has been doing the coding, things like that. They have just as much of a need of having a business person to be paired with them, so that they have that other part that they're missing. So it's rare that you will find one particular entrepreneur that knows everything. They just don't. And so you have to make sure that when you're putting your team together, that you have the right people that can be able to speak to all of your different kinds of, especially your basic milestones you're going to be hitting and your basic risks. Did you have a question?
Can you give any ideas about where you can find these team members? I mean, we have a lot of people here working in groups, and I'm one of the technical people, and some of the people are not technical. And so, do you have certain places that come to mind when I ask that question that I can be looking for the other parts of my team?
Let me repeat the question. So the question is, how do I find other parts of my team that complement me? If I'm a technical founder, how do I find some of those other people? Networking. That's my one answer to this. So it's everything from going to Venture Cafe on Thursday evenings to looking at specifically what you need and talking to a bunch of people and saying, I need someone who would do this or that. Can you help me find that person? Network. It's really networking.
Just one thing to add back to your question. And so I'm typically, as an individual investor and accredited investor, I'm in before they are. And so that's why the co-founder is more important to me. So I'm investing before they may have had a chance to really formulate that team. So
There's a question back there. Yeah.
I just wanted to add to what Christine was saying, because Christine is my landlord at St. Louis Venture Works, and it is very important to have those people that you can go to, because when I first started my business, I knew nothing but to make cakes in a jar. But those financial aspects, those people that were out there to assist, and she, at the office, they did develop teams for me. So I had a financial advisor, and I had those people that had already walked this journey that kind of advised me through the process. And I use them as mentors. I mean, we talk all the time, we have meetings and all of that. So they kind of guide me through the process. And as she said, with the networking, as I told you all earlier about the Venture Cafe that's happening on Thursday, it's out there, and it's people that are out there that would love to assist and hear your business ideas and things like that, but you just have to get out there and make those connections.
I'm interested, and I'll try to steer this to your particular expertise, but in finding sources of operating income pre-revenue, and what role debt or a complicated cap table or something, plays in later down the road when you guys start getting involved.
Meaning, if we're looking at a deal that has a lot of messiness to it because the entrepreneur had to do what he had to do or she had to do to bring in the capital to run the business, it's par for the course. There are things you can do along the way. Let me say this, sort of putting my law hat on for a second. We're working with a company right now. It's about to receive a $5 million investment from a venture fund. And they were right here when I started with them 6 years ago. And they have, they kind of drifted from me and just sort of they hired a general internal lawyer to do their work. And they have now 55 investors, side deals, undocumented. The cap table is a mess. There's just so much going on that's inhibiting this deal from closing. And so they're sort of at the table with the professional source, and it's a mess. The professional source is like, yeah, we get it. You did what you had to do to get to where you are, and they're working with us to clean it up. So I wouldn't say, there are too many fatal mistakes you can make, particularly when you're this early. You got to sort of go ugly early to, get your product to the market, and everyone should understand that at this level. There aren't too many things that can't be cleaned up.
We have a phrase that says, every deal has some hair. Every deal has something about it that's just unusual, different about it. It's not something that would stop someone who really wants to make that deal. If someone says, I really see a lot of value in what you're doing, but we need to clean up a cap table. We need to restructure something. It can be done. It can be done.
I have nothing to add to that.
If I could ask a follow-up, one of the things that particularly concerns me is bootstrapping.
Yeah.
Is a slow growth curve because of lack of capital to either develop quickly, get the product to market, or even market it quickly. Whereas I think it is could be a hockey stick, right? Software as a service is what I do. I'm curious, do I have to be worried about things like that?
In terms of bootstrapping, I think it can be a plus in the sense that then you don't have to take equity, especially at earlier stages. And if you can get through major milestones without needing to do that, that's great. On the other hand, too, if it's inhibiting growth, especially if you have competitors that could take that market away if you're not growing, that's where it can be a big issue. If you're not growing and reaching your full potential, especially if where you are is you're needing marketing dollars to be able to reach to be able to reach people and get your product in the market.
What's your choice, right? I mean, wanting capital and getting it are two different things. So you have to keep pushing and getting to those milestones however it takes. And if it means bootstrapping and leveraging the house and the kids, choice.
Can we do Charles and then? Sure.
A question probably straight to Scott. So when you initially talking about, when you looking to the investment, you see the company say about the purchase funding and stuff. But if the company never got the investment, but say raise capital from seed money from SDR, those kind of fundings, how you evaluate that?
Well, if we're looking to make an investment in any given round, we're not going to lead that round. Someone else has to say they're in, and we would consider that as a sort of check the box, we may invest. If you're saying, would we invest in a company that hasn't raised capital before, our short answer is no. You need to have raised at least $250,000 from outside sources for us to consider investing in your company. That doesn't mean, that's just our criteria for our investors. Is that?
The seed money from SBI, you don't count that as an investment?
No. Like as a grant?
Yeah.
Yeah, no. We wouldn't consider that as a, because we want someone to set the valuation for us. And we may not like it, we may not invest because we still think it's poor, but if someone else who understands the space, perhaps a bigger fund than ours, is leading the investment, that's just important for us at where we are right now.
Totally agree with Scott, but I would also add this. Companies that are very good at getting SBIRs, STTRs, other types of grants, that's non-dilutive money. And that is a very good way to go, because if you look at a company like that who's been able to get those grants, you know that your dollars are going to be able to go a lot further. And so that in my opinion, has a much, it has a real positive effect on someone who's an investor, because they look and say, wow, my dollars can go much further and get this company to further milestones because this company has a track record of being able to get these grants.
I would just like to add, even from my level, it matters to me who the other investors are, if you do have other investors in your company. And so I want, I have a reputation. I want to be associated with investors that have, a good reputation as well. So.
Yeah, I just wanted to add something, just a word of caution about a particular kind of bootstrapping. So bootstrapping is great, and I absolutely agree with our panel that no one's going to hold financial dilution that you maybe took, or they're going to love the fact that you had revenue, right? But sometimes, particularly in the life sciences, and maybe also in tech a little bit, if you offer your platform as a service to get some bootstrapping revenue, then you might be experiencing some rights dilution, where you give away some future rights to your technology down the road. And that kind of dilution, I think, can be a showstopper, as opposed to just regular bootstrapping where we mean just get some nice revenue in. So be careful that your service agreements, if they do have some kind of downstream rights that the person that's giving you the revenue buys with that revenue, that you just want to be sure that that's very, very carefully thought through if you're going to need to raise some venture capital, because that can really be a showstopper.
So Craig, could you tell us a little bit about where you are in this spectrum in terms of, as an individual investor, how are you finding deals? How are you evaluating deals?
Typically, any deal that I've invested in, someone has come to me, has approached me. I haven't gone out and really looked for specific deals or anything like that. So it's probably word of mouth, or just a friend that knows what industry I was in, has a friend that started a business, and so I've come in at the very early stage.
We've heard some of our guests talk about preferring to stay in their own vertical, where they feel like they have the best ability to evaluate. Given your background, what do you consider your vertical?
My vertical, I would say, is the brokerage business, bond market, bond business. I sold securities to other financial institutions for their investment portfolio. So finance is my background. So for me, staying within my vertical is not that important, as long as that founder really understands their business.
But I did hear you say that as part of your due diligence, you're looking not only at the team, but also at the other investors that have the potential to come to the table.
Yeah.
Are there any other things that you look for in that process?
I think that for me, it's a matter of how organized that person is. I'm pretty particular, so I want to see that they are organized, even if they aren't, don't understand the financial side or the accounting side. They at least pay some attention to it, just to show that they are looking at the overall business. And I think it was Michelle, that commented on it. If you're not looking, if you're not managing your books properly, doesn't show me that you're going to care about my money that I invested. So that's a big thing for me.
Great, thank you.
My vertical's bio. I've spent more than 25 years in various operating roles in bio, everything from pharmaceuticals, medical devices, nutrition, agriculture, those kinds of things, food, and have invested in them as well. So I've done both the operational side and the investing side in those spaces.
Yeah, I would say, just to add, I think the holy grail is smart money, if you haven't heard that term. Smart money is someone who understands your business. You know, you may feel like, God, I'm going to get $50,000. I don't care if they have a pulse. But the smart money is usually surrounded by other people that also know the industry. And you're going to need more money. And so if you can prove to the smart money that their first investment made sense, then they're most likely to follow on with additional financing or help you find that money. So it's not always easy to find. Not every vertical in this town, you know, or not every company is sort of meets the vertical in this town. I can say that when we invest, we're in a number of different cities. We want to know where the exits were in that city. You know, if Kansas City, it's ag tech, right? There's more than you can imagine. That means that there's a universe of people out there that understand your industry that are going to be there to support this company as it grows, whether that's through advice or through financing in some way. So, you know, it's important. It's an important factor to have sort of an understanding of your space and trying to find that smart money.
We're going to go behind you, and then we'll come back to you, okay?
Hi, my name is Kathy, and I founded a non-for-profit, and I'm already selling a product, kind of like these bags and some other products, and I see it growing slow. I'm only on my second year, and I'm already selling. It's all been my own money and bootstrapping and charging to cars the initial products, and already have repaid that. But I have a full time, and I don't know now. Everybody's telling me, all of my mentors are saying, where's your team, where's your team? You need to grow and you need to expand, and for that you need money and all this stuff. But I don't know which kind of money do I need to raise. I just don't know where to turn, because I feel like, oh, it's been saved. It's been almost like a fun hobby, but obviously I am kind of spreading myself thin a lot, but I do love it. It's not going anywhere. It's going to continue to grow. But I just don't know what is the best way to find money, what kind of money I need to find at this stage. And I also wanted to add that I'd like to quit my real day-to-day job sometime in the near future, but I don't know what steps I need to take next.
I think a business plan would inform that, right? If it's sort of where are you going, and what do you need to get there, and so that'll sort of you'll back into the answer to the question. I think ultimately with a financial model that sort of requires you to think through how much capital do I need to get to these milestones to get to where I need to be. I don't know of another way of.
It's the not so fun part.
Assuming it was 6 months and $200,000 or something like that, to hire 3 people with this salary and this much marketing expense, how would she do that answer? How would she get the $200,000?
I need $200,000.
Well, I will. The caveat I will put is, in this case, your tax structure matters, right? So we have no equity to play with, right? And there has to be a charitable purpose that has to be reinvested into the charitable purpose. So in this particular example, if there are nuances here, but if we were to pretend like you're an LLC, with them, no.
That has been also another recommendation, is to turn it into a for-profit and then still have the ability to do the charitable mission. Because I have been selling, I know definitely I do need to expand, grow, have a team, and it's almost time, but I'm stretching myself as far as I can go, and it's not fun.
I'll try a shot at this. This is a difficult one, because I think some of this comes down to your taste. You know, what do you want to do with your business? What's the intent of your business? Are you doing this because you want to get out of your day job and do this full-time? Are you doing this because you want to, so you have to do some soul searching. I think Scott's idea of putting together your pro forma, and I think that the part about pro forma, yeah, it's important, but I think the assumptions behind your pro forma are just as important as your numbers that you're putting down there. So you need to understand, where are you getting those numbers? What's your assumption around each one of those? Because you need to look at those risks. You don't want to quit your day job and find out that you had a pro forma that was on the really high side of everything, and then you quit your day job and you don't have anything. So I think you need to do some soul searching and try to figure out what you want to do with this business, why you're doing this, what kind of, if you are going to turn it into a for-profit, what you're going to need to have to live on is a for-profit. I don't know what your current situation is. I don't know if you have a bunch of student loans. I don't know if you're trying to, what you're trying to do in your life. But you need to sort of have an understanding of what you need as an entrepreneur.
I think you asked Michelle earlier also, where do you find these investors? And I think Christine kind of answered that question earlier. The networking events, Venture Cafe, I've gone there, and it's not just people that are pitching their ideas or just there to meet people. There's investors that are there as well. So I went to events like that. So I pose a question to Christine and Scott. So as an entrepreneur, you're looking for investors. Should you be careful as to who you go after in terms of possibly being sued if your company fails? Do you necessarily have to look for an accredited investor, or?
So yeah, I think you do need to be really careful. You don't want to just take anyone's money. You do want that smart money that we were talking about earlier. We'll come back to that topic. You're going to want people who are going to be able to add value. We talked about then having these investors be part of your board, having these investors be active within your company and helping you to succeed. So you're going to want folks who are going to help you to do that. You're also going to want folks that are going to help to bring in the next round of investors. So if you're at a certain level right now, you might say in another year or two, this is the next kind of investment round, and what will I need done? Will these people who I'm bringing on board now help me to get there? And ask them, what have you done? What kind of investments have you done? What kind of areas do you invest in? Like I said, I'll be glad to get anyone who wants this money map that talks about what different kinds of investors. It doesn't have angels on there, but it has standard investors and dilutive and non-dilutive in different clusters. So if you are in a tech cluster, here are the types of investors that typically invest in you. If you are a fintech company, here are the kind of, if you're a bio, if you're manufacturing, here are the types of companies, and all of them have different kinds of needs.
So I would say there's three pathways to find that $200,000. You're born into a wealthy family. I'm thinking about my clients and who successfully raise capital. There's a category, universe of people that have access to capital because of their friends, families, etc. It's just a reality. If that's not you, how do you get access to the very small community of active angels? It's a very small community. Well, I think one pathway is through the accelerator programs and the active mentorship programs. There's an old adage, if you want advice, ask for money. If you want money, ask for advice. It's true. So that's the second pathway, is get into the accelerator pipeline that gets you into a community of people that are actively looking for deals and looking to mentor. But even that's a very, they're not accepting everyone, and they can't serve everybody. The third category, I have a client in mind. She is an advocate for her business like no one you've ever seen. The most natural networker. If you're having coffee with her and you say three names and she's not, you'll get an email afterwards. Could you make an introduction to these three people? And then she follows up, and when she's at the meeting, she's telling them how great I am. It's just a natural skill. Like, I made the referral and she's talking me up. And that comes back the other way. And she raised her money. And it was just aggressive, appropriately aggressive follow-up and just getting in front of everyone and being an ambassador for your business. And that creates a buzz about what you're doing. The Business Journal, there's different ways of getting those little tiny articles, that just validate. They're always looking for content about a new business. It's out there, but it's not like a bank. There isn't a bank to go to. There isn't a financial advisor who's just selling early stage investment opportunities. There's just not. You have to, if you're not born into it and you're not accelerated into it through some of the programs in town, then you have to sort of say, this is going to happen, and I'm going to either partner with some people that have access to that capital or get out there and just find people that understand what I'm doing. And it's not going to be the person you talk to, it's going to be the person they introduce you to, or the person that person's introduced you to. And someone used to say, for every person that invests, I talk to 100 people. And so it's a big, big, big project. But it works. I mean, the good deals with good, strong advocates for the businesses get funded, get through this stage.
I would just add that you can't skip, you can't leave. So if you haven't done the hard work of putting your pro forma together and putting your business plan together and figuring everything we've been talking about for 9 weeks, you meet the perfect person, you don't close the deal. And the odds of you convincing the perfect person that there's a deal to be closed are slim to none. So as much, you're hearing themes. And the theme primarily is you have to do the work. And some people say, work it like a job. Work it like a job. Sounds redundant, but think about it that way. It's got to have that same level of rigor, which is why you need to carve out these nights as we come to a close in the first week of December. You need to carve out this time and keep that time. It doesn't have to be Monday and Tuesday nights, but if you don't carve out this time, you won't do the things that need to get done. Mark.
I just wanted to point out again, we've had this conversation before, at least from my world, where products are tangible and produced. If you need investment and you have a product that's proven, not something that's kind of wishy-washy, nothing's wishy-washy, I get it, but something that maybe to an investor might appear a little less stable, let's say, being very judicious in our word choice, I would start looking for the companies that you want to become. I would identify those firms. I'd join the trade associations therein. I'd replace my Monday and Tuesday nights with volunteer work there. I'd ask for a lot of advice, and I'd view myself not as somebody that was asking for an angel investor, but as somebody who, instead of presenting the EBITDA, was now presenting gross margins on my product as to why I would be a good bolt-on or why I would be a good joint venture prospect for what they already do. I mean, if you think about it, what their pain point is at that next level of growth up, that sort of lower middle market, that mid-range 8-figure net rev, one of your most difficult tasks at that stage is new product development. It's keeping that growth train going. You can always hire new salespeople, but you're too small to compete against Caterpillar and General Electric for talent, but you're too big not to grow at a very accelerated rate. So your path generally has to involve some kind of proprietary new product, along with the talent to really be a champion. And you would be the champion in that scenario. So I would consider maybe framing what I was doing as a joint venture and pitching it to industry. You'll never even appear on Christine or Scott's or Craig's radar screen. You just sort of disappear into the excerpts and get absorbed into somebody else's P&L, but it'll get you where you want to go.
Mark brings up a fabulous point in the sense that corporate partners can add a lot. Whether you are looking at increasing your bottom line, whether you are looking at potential exit, whether you're looking at investment. A corporate partner in terms of investment is the super smart money. So if you want to look at where, if all of a sudden a corporation has, that has a lot of people, has been able to put their very best people in terms of your due diligence and said we're going to invest, that's super smart money and can many times bring venture capitalists on board. It also can open doors in terms of partnerships, you working together, and can open doors in terms of exits. So there's a lot of great things. The second thing is that these corporates, many times, because they're so big, have many different kinds of resources that you need. They may have done all kinds of marketing right in your area, and that you would never be able to pay for. It'd be so expensive for you as an entrepreneur to get. But they would already have this sitting on the shelf, and many times they're more than willing to share this with you.
I was going to add to that, the Goldilocks spot is super important when you're looking for a joint venture partner. If they're too small, they're not going to be able to do the deal. And everybody will tell you they can do the deal. The reality is they're going to figure it out after the fact, and you don't want to be in that situation. If they're too big, if they do the deal, the buy ratio will be a lower percentage than Scott's due diligence and investment percentage. I mean, if that had landed, something had landed on my desk at Toro, I actually did those in a $2 billion organization, but the percentage of those that I did and the time that it took was really, really cumbersome, or would have been cumbersome on the other end of the deal. What you want to find is somebody that's big enough to be financially stable and have the cash to make it happen, and small enough to where you know exactly where their pain points are and you can solve those pain points. If you know product champions, growth, channel expansion, margin improvement are pain points, you're their answer, because at a $25 million rate, a $50 million rate, it's not like they're going to go out and compete against John Deere, General Electric, Toro, to go hire away talent. They need somebody like you. So it's not just your product and the margins that your product delivers to their overall picture. It's the fact that you are now a part of the deal. You're now a part of the product. So you're the primary champion. You're the growth vehicle for whatever they did do with you, joint venture or otherwise. Another thing too, having been on the large corporate side of those before, the language that is usually good language to open with is letting someone know that whatever it is that you do, it will quote unquote margin their overall portfolio up. Because the pressure on their end, the pain they're hearing from their boss, is how are you going to turn more product and how are you going to turn it more profitably. This is a deal, Scott, that will margin your overall portfolio up. I have professional expertise to channels you're not in. When can we talk? Scott's already, I might not get the deal, but I've got his attention better than somebody else wandering around with a cocktail napkin going, hey, my cousin said I had a good idea. Scott doesn't care about your cousin.
Another source of capital are your customers. I'm thinking about the last few deals. Among the last few deals that we've done on my law firm side, right now the $5 million venture investor is the company's biggest client, the biggest customer, my client's biggest customer. So think of that also as a potential channel for early stage money, as someone that's using your product or service, and this provides a way of gathering additional market.
So we're coming to the end of the time. Just final thoughts from each of you on really this entrepreneurship thing, not necessarily just on capital and financing, but any words of wisdom. You've all spent a lot of time with entrepreneurs, so if you have anything you'd like to share with them, that would be great.
It's a great time and a great city to be doing this. Right? I've been doing this for a long time, and the resources available to support you, the attention, the spotlight on early stage companies, everyone's talking about it, no one knows how to get into it. There's definitely more opportunities to have conversations to advance your business with people that can help than in my career in St. Louis. So dig in and listen to, get good advice, listen to it, and keep pushing.
Know yourself. Know where you are good and where you're not. Surround yourself by good people. Networking is really important. And I think really looking at, there's no right way or wrong way to do what you're doing. But the hard work is really important. So think smart, work smart, but work hard too. Have some fun.
I would say just always continue to try to obtain knowledge in your, whatever, in your industry, your product, and your service. Even if you have done whatever you're doing for years for another corporation and you're breaking off on your own and think that you know everything about, I think you should always just continue to try to obtain knowledge. And I also think that it is really important to have a board, no matter how big or how small you are. I think that was brought up earlier, but having some type of advisory group that helps you make decisions, or at least, if nothing else, that you can vet your ideas to and just see how it sounds, saying it to other people before you go pitch to investors.
Well, thank you all for making time.